All right, today we're going to unpack a really fascinating tool called the negative volume index. It's this indicator that tries to solve a classic market puzzle by, well, looking at everything in a completely backwards way. Just let that sink in for a second. We're always told that big volume, that's where the action is. That means conviction. But the negative volume index, or NVI for short, is built on the exact opposite idea. It asks, what if the real story, the important stuff, happens on the quiet days? So the whole theory behind the NVI basically splits the market into two camps. First, you've got the crowd. This is, supposedly, the less informed, maybe more emotional group that jumps in and out of the market on those high-volume, high-hype days. Then you've got these so-called smart money, the pros, the big institutions. The NVI operates on the assumption that these folks prefer to make their moves when things are quiet, on low-volume days when all the noise has died down. And that's exactly what the NVI was designed to do. It was built to completely ignore those loud, high-volume days that are supposedly dominated by the crowd. Instead, it zeroes in only on the quiet days, trying to get a signal on what the professional money is doing. Think of it like a noise-canceling filter for the stock market. Okay, so how does this thing actually work? Well, the mechanics are surprisingly simple, but also pretty clever. Let's break down how it's calculated. The NVI is what's called a cumulative indicator, kind of like a running score for the market. But here's the big twist. The score only changes on days when trading volume is lower than the day before. If volume goes up, the NVI doesn't move. It just sits there waiting for things to get quiet again. The calculation itself is a really simple three-step process. First, you just start the index at a nice round number, like 1,000. Then, for every trading day, you just look at the volume. If today's volume is higher than yesterday's, you do nothing. The NVI stays exactly the same. But if the volume is lower, then you adjust the NVI up or down based on how much the price changed that day. And that's it. It only pays attention when things are quiet. And this isn't some brand new idea that just popped up. The core concept was actually developed way, way back in the 1930s by a guy named Paul Dysart. But it was an analyst named Norman Fosback who really brought it into the modern era in 1976, creating the quantitative version that you see on trading charts today. Okay, so we know what it is and how it's calculated, but how you actually use it to make a decision, because that's where things get really, really interesting. So the most popular way to use the VNI is to plot a long-term moving average right over it, usually a 255-day average, which is about one trading year. The trading signal happens whenever the VNI line crosses above or below that moving average. Simple as that. And this right here, this is the quote that made the NVI famous. Norman Fosback, in his book Stock Market Logic, made this absolutely incredible claim. A 96% chance of a bull market when the NVI is above its one-year average. I mean, that is an astoundingly high number, and it's what put this indicator on the map for a whole lot of people. But, and listen, this is a huge but, the indicator is not a two-way street. While it's apparently really strong at sniffing out bull markets, its track record for spotting bear markets is, well, much, much weaker. According to Fosback's own work, there's only a 53% chance of a bear market when the NVI is below its average. I mean, that's barely better than a coin flip. So it's widely considered a pretty poor sell signal. So the theory is really compelling, right? But how does it actually perform in the wild? Does this smart money indicator actually beat just buying the market and holding on for dear life? Let's take a look at the data. Okay, so here's the setup for a quick backtest. We're looking at the S&P 500 from early 2017 to mid-2020. And that period's great because it had a strong bull run and the massive 2020 crash. The NVI strategy is simple. You're in the market when the NVI is above its moving average, and you're out holding cash when it's below. And we're going to compare that to just a standard buy and hold strategy. And right out of the gate, we get a surprise. Over this period, the simple buy and hold strategy actually won on total return. It gave you 40% compared to just 30% for the NVI strategy. So if your only goal was to end up with the most money possible, well, the NVI strategy actually fell short here. But hang on, total return is only half the story. Just look at what happened when things got really ugly. The max drawdown, that's the biggest loss from a peak to a trough for buy and hold, was a gut-wrenching 34%. The NVI strategy, by getting you into cash, cut that loss almost in half, down to just 19%. That is a massive difference in how that period would have felt as an investor. And this table just illustrates that trade-off perfectly. You see the lower return for the NVI strategy, sure, but then look at the Sharpe Ratio, which is a measure of your return for every unit of risk you take. The NVI strategy's Sharpe Ratio is way higher, 0.56 versus 0.40. What that means is, for the amount of risk involved, the NVI strategy actually delivered better performance. It was a much, much smoother ride. So what does this all mean when you put it together? How should we really think about the negative volume index as a tool in our toolbox? I think the key here is to see the NVI as a specialized tool, not some kind of magic treasure map. Its strengths are pretty clear. It has a great track record for identifying when conditions are right for a bull market, and it seems to do a fantastic job of helping you sidestep the absolute worst of a crash. But its weaknesses are just as obvious. It's a lousy sell indicator on its own, and like any indicator, it can definitely give you false signals in choppy markets. And that really brings us to the core takeaway here. The NVI probably isn't a strategy for beating the market in a roaring bull run. Its real superpower, as the data suggests, is in risk management. It's a tool that might just help you sleep a little better at night by keeping you out of those catastrophic downturns. And that really leaves us with one final question, one that gets right to the heart of your own personal investing philosophy. What matters more to you? Is the goal to squeeze out every last possible percentage point of gain, even if it means living through those gut-wrenching drops? Or is it more important to smooth out the ride and minimize the pain of those major losses? The answer to that question will probably tell you everything you need to know about whether a tool like the negative volume index has a place in your strategy.